Welcome everybody to today's financial performance for Q2 2023. I dropped a poll. Would love to hear if this is the first one that you are attending. We're going to go ahead and get started here. Today's speakers are Cameron Wu, our VP of Investments, Jake P., our Director of Operations, and then again, my name is Korin Hedlund, and I lead our investor relations team here at Arrived. A quick disclosure, this is not a research report or investment advice. All opinions expressed in this webinar are those of our presenters, and past performance is not indicative of future results. Quick agenda, we're going to walk through briefly the Q2 highlights, rental properties as a whole, vacation rentals, dividends from the last quarter, share prices, and then we do a live Q&A session. So for those folks that are new, feel free to drop any questions that you have in chat. Primarily, it'll be focused on the financials from the last quarter, but if there's any 101 related to Arrived, feel free to drop them and we will get to those as well. Awesome. I'm going to welcome Cameron Wu up to the stage, and I will see you all during Q&A.
Thank you, Korin. Hello, everyone, and welcome to the Q2 Financial Performance webinar. Thanks so much for attending today. So just want to quickly go over some high-level stats today. Then we'll go over both investment classes, some high-level operating metrics. And after that, then I'll welcome Jake Pruchno to the stage to go over some financial returns metrics. Yeah, so, Arrived is the largest platform for investing in fractional residential and vacation rental properties. And we really focus on the IPO, the individual property offering. So to date, we're in over 45 markets. We've IPO'd 257 SFR long-term rentals and then 37 vacation rental IPOs. So really excited to see both categories growing nicely. It was only about 9 months ago that we offered our first vacation rental in Nashville. And now we're at 37. So excited to see the growth. And we're almost at $100 million of property value funded with the investment community. So thank you so much for all of your support throughout our journey. Next, this is a visual representation of where the Arrived properties are located. So you'll see, it's kind of scattered between the Southwest and the Southeast, with the primary concentration in the Southeast. Most of our long-term rentals, or a heavier percentage, are going to be focused in that area because we can find high rents with cheaper entry prices for the homes. And there's just a lot of growth in the Southeast. So we're going to talk about occupancy rate with our single family residential. And just to give everybody a quick kind of high level overview of what is that occupancy, it's just the number of occupied properties over the total properties. Now, one caveat I'll add to that is we look at the stabilized occupancy rate. And basically that's just a measure of properties that have been seasoned in the portfolio long enough such that they contribute to the material operating results. We buy properties and we keep introducing them onto the platform. So the number of properties in our ecosystem keeps changing. So to account for that, we look at a stabilized measure where, once they have been in the portfolio for a certain amount of time, then we start tallying up those results. So on single family residential, we were at 93.5% occupancy as of Q2. We signed 51 first leases, so a really great leasing quarter, and that is to be expected as Q2 is probably one of the best seasons to lease single-family residential properties. Our average lease term is 23 months, and that's going to be a big noticeable departure from the industry standard of a 12-month lease. This really has to do with our investment thesis that we're looking for households and residences that are willing to commit to the property, treat it as their own, and that is our cash maximizing strategy to get people to really nest in that property, orient their life and their schedule around that, and they have a higher chance of renewing. Plus, nobody likes to get their rent increased every single year. That's the number one thing that's going to drive people out of a property, is the prospect of getting their rent increased every year. So we opt for a 2-year term for the reasons I mentioned and think it's the cash optimizing strategy. And again, we had a really strong leasing season. So of those 51 properties, 88% leased above the forecasted rent. And that average delta was 8.9%. The average pro forma rent was somewhere around $1,650, and we outperformed that number by an average of $150. So not only was the quantity of leasing high, but also the rent achievement was really great for us this quarter. Moving on to vacation rentals. A couple stats here. Maybe we're a little bit less familiar as a group on what some of these are. So I'll go into, say, occupancy. So we had 57% occupancy as of Q2. And that is for all properties that were bookable in Q2. Every property, there would be, say, 91 days that they could be leased or booked out. And of that, we captured 57% total of all those days. So there were 920 nights stayed in Q2. The highest property that we had occupied was the Palms. That particular property had a really great booking where there was a household who was looking to book it out for a month straight. So that definitely contributed to the occupancy. Probably not something that we expect as an ongoing concern, but definitely good to see that there are guests out there that are willing to commit to those longer stays. And owner's revenue total, almost $300,000 earned in Q2. So we had a 4.8 average rating for all properties, which is a really important mark to meet because that's when you're getting into superhost status. So if you look on Airbnb, for example, that 4.8 is the mark of that label of superhost, and that's extremely important. And just a little testament to one of our properties in Broken Bow, Oklahoma. We frequent the Hochatown area every year for summer, almost for 15 years straight. Hands down, the favorite stay. And this was a new home, so we're definitely purchasing great assets that create great vacation rental experiences, and got the coveted 11 out of 10 recommendation. So anyway, want to turn it over to Jake Pruchno now to go over returns.
Awesome. Thank you very much, Cam. We're going to start with a refresher since it looks like about half of the folks joining us today, this is their first quarterly financial webinar. So first of all, welcome and thanks for being an arrived investor. So how do you actually earn returns from investing in real estate? There's two components. The first is the dividends. So this is the cash flow that each of the properties is generating that gets distributed out to investors. You should see your dividends in your account, your bank account now. And if not, give it a day or two. And then if you still don't see it, reach out and we can take a look. The other component of how you earn returns is appreciation. And so this is talking about the change in value of the shares that you own in each of these properties. Now, those dividends are considered realized because we've already paid the money out. It's in your bank account. You can do whatever you want with it. That appreciation is considered unrealized because even though the estimated value of those shares has changed from the initial $10 per share price, you still own the shares. You haven't sold the shares yet. And ultimately, that appreciation component will become realized when we eventually sell the property, which is still several years down the road for pretty much all of our properties. So we'll talk a little bit through dividends first. This quarter, we paid out nearly $800,000 to investors, which is super exciting. And you can really see the growth of the Arrive platform in this slide. From even a year ago, we only paid out almost $200,000, and the amount that we've paid out has pretty much gone up by 4x since then. So a lot of exciting growth, a lot of new properties and investors, and it's really exciting to be on the journey with you. We'll look at these dividends now as a percentage. So this is a chart that is showing the current dividend rate for all of the properties that paid out this quarter. Now, this is basically taking the Q2 payment and then extrapolating it for a full year and dividing by that initial $10 per share price to take a look at what rate of return these dividends are at. And for most properties, they seem to be in that kind of 3 to 5% ballpark on the dividend yield. There's definitely a lot of confounding variables on this chart that don't make it apples to apples. There's different markets, properties with and without leverage, all sorts of kind of different factors that go into, what are the returns. But I think one thing that's worth talking about is that long-term focus that Cam was just talking about. So we start with pretty conservative initial payouts, and then we adjust as we really see that property's performance. So in Q2, we actually had 157 properties, about 77%, that paid dividends this quarter that were higher than their initial estimated dividend rate. And it generally plays into our investment strategy as a whole. Like Cam was just talking about with those longer leases on the single family residential side, you can kind of start to see an inflection point at about 12 months or so where we've been able to increase the rents over time, which correspondingly leads to higher dividends paid out to investors. Now we'll go a little bit into share prices and appreciation. So that appreciation component, the change in value of what you actually own, is what measured by something called share prices. Arrive shares start at $10 per share when you make your first investment, and then we start to revalue what those are worth. And for the single family residentials, we're starting to revalue those 6 months after that initial investment. And for the vacation rentals, we're starting to revalue those after 12 months. We can get a little bit more into that in the Q&A. Now, the share prices are basically formed by taking an estimate of what that property is worth today. What could we sell it for if we decided we want to turn around and list it? And then we also combine that with all the other assets and liabilities that that LLC owns. So it factors in things like the cash reserves on the property, any loan that's on the property, any accrued property taxes that haven't been paid out yet. And that basically spits out an estimate of what those shares were worth. If you were to try to sell your Arrive shares today, what reasonably kind of is the market value. And so this is we'll spend a little bit of time here, so don't be overwhelmed by all the numbers, but this is a look at the average share price, grouped together by how long properties have been owned for. So in that first row, we've got 6 properties that have been owned by investors for 26 months, a little bit longer than 2 years. And of those 6 properties, the average share price is $17, which represents a 78% increase from that initial $10 per share price. Now, a couple notes on this slide as we talk through it. For one, this average gain since IPO is not annualized. This is looking at the kind of total appreciation, regardless of how much time it's been. This is also looking at only those long-term rentals, because like I was just saying, we don't have the vacation rentals revalued quite yet. Now, and the last one is one from our legal team. Keep in mind that these are averages. Within each of these individual cohorts of properties, there are properties that have well performed, that kind of outperformed that average appreciation, and there's other properties that have underperformed. We're purposely kind of looking at an average here for analysis point of view, but the actual results of individual properties may be well above or well below. So that said, let's talk a little bit about what's gone on in the market over the last year and a half or so. Really the story of 2022 was the rising interest rates, which started to have a little bit of a pullback on the housing market values. So we saw last year that share prices rose in Q1, Q2, and rose slightly in Q3, and then really started to pull back at the end of last year. A lot of the properties saw share price depreciation in Q4. And then Q1 this year was pretty mixed. About 65% of the properties had an increased price and about 35% had a decreased price. It seemed to signal that the market had stopped kind of completely coming down. It was starting to see a bit more of normal fluctuations, kind of regular changes of regular velocities and magnitudes depending on the different markets. And then in Q2, we're starting to see a lot more appreciation. So this quarter, we actually saw 90% of properties gain in value over the last quarter. So you can kind of see that story in this chart as well. For all those properties that have been owned for 13 plus months, they really kind of caught that run up that was happening in 2021 and 2022. And then those properties that have been owned for 9 to 12 months are those ones that were bought last kind of summer, early fall, kind of when the market was at a local peak, and then kind of pulled back a little bit, towards right at the end of the year. But then those properties that are in month kind of 7 and 8, you're starting to see some appreciation already. This is properties that we bought in December or January when the market was still kind of coming down a little bit, and they've caught a little bit of appreciation over the last 6 months. So again, here, this is all largely for educational and informational purposes. The actual appreciation will depend on what we ultimately are able to sell the properties for. And again, we have a kind of minimum 5-year hold period thesis for these properties. So even these properties that have been owned for 12 months or 26 months, we still have at least another 3 years or so before we start to seriously evaluate if it's time to sell the property, realize that appreciation returns, and distribute funds to investors, or if we want to continue to hold those properties. This also really showcases the magic of dollar cost averaging, the idea of buying into real estate as the market goes up and as the market goes down. It's really, really hard to time the market and know exactly when you hit the bottom and when things are going to be, up and to the right from here. So it can generally be a great strategy to just buy shares, as the market goes up and as it goes down. And that's really well illustrated here because it's really hard to know in the moment that, hey, in December, January, that would have been the time to start buying shares. It can be a lot safer to just continually invest, no matter what the market's doing, in order to kind of smooth out the effect of timing the market. And now our last slide here, we're going to look at the same data that was on that previous one. We're looking at the gross returns, so not annualized, but now we're taking the appreciation and the dividends and basically adding them together, looking at all of the properties that Arrive has across time. And this is, again, only the long-term rentals because they have that appreciation component, already. So you can see here that the gross returns for the first 5-6 months look super low. And of course, that's because those properties haven't had their first share price revaluation. But I think what's really interesting is to look at that grouping from about 6 months to about 15 months old. And in those cohorts, we see that it looks like about half the properties are positive, about half the properties are negative. And then as you look at those properties that we've owned for longer, that had that kind of higher average appreciation amount, we see that really the entire grouping of properties kind of tends to move a little bit up and a little bit to the right. And so this really kind of shows the effect of, the hold period on real estate. Real estate as a whole isn't an investment that's designed well to, buy today and sell tomorrow. It's much better in its performance when you buy and you hold for a multi-year period. So the other thing that this highlights well is the difficulty in picking the winners from any particular group of properties. By the time we acquire properties and bring them onto our platform, they've all passed some pretty rigorous due diligence and underwriting screening. But even then, it's hard to know which property is going to be the cream of the crop. And so, we generally, tell folks that it's can be a safer strategy to just invest in several different properties and diversify even across a group of properties that all launch at once. Then you can kind of see that performance over time. And, we're hoping to see these trends continue, where as we look at, older and older properties, we tend to see, larger and larger appreciation. The real estate market can kind of go up or down on kind of a month to month and quarter to quarter basis. But if you look at over kind of the last 30, 40, 50-year trends, things tend to be upward. And so even though there's been some short-term turbulence with the Fed's actions, inflation, kind of all the things that are plaguing the macroeconomic conditions, we're really kind of encouraged by the early signs and excited to see how these properties continue to perform over that kind of next 3 to 5 year period before we look to sell this particular batch of properties. And with that, that's going to kind of conclude the prepped presentation, and we'll welcome Cam and Korin back on and do a little bit of Q&A.
Fantastic. Cameron and Jake, thank you so much for your prepared remarks. I know we have a whole host of great questions coming through the chat, so thank you for your patience. We do have prepared remarks that you walk through, and then we always aim to answer all questions that come through chat. So let's get it started here. The first one we have in chat, dividend question. I noticed one of the properties had a slight decline in dividends during Q2. So it went from 0.08 to around 0.07. Maybe we can discuss the reasons why dividends would go down somewhat for a property. So Jake, I'll kick that one over to you.
Yeah, there's a lot of factors that go into determining, what is the right dividend to pay out for a property. So especially with a small change from kind of 8 cents to 7 cents per share. So let's just talk about the dividend strategy as a whole. In general, we aim to pay out the income that the property is generating. So we basically take a look at the last couple of months and say, hey, we generated this much rent, we had this many expenses, and let's take the delta and pay that out to investors. That's the kind of macro idea of how determining the dividend amounts works out. But the other thing we do is we look at the cash reserves. So each property has kind of a savings account for a rainy day where we have money that can be used opportunistically for property improvements that we want to do to increase the value and increase the rent we can achieve. Or it can be used if there's an issue with the property. So say that a tenant leaves and there's a vacancy, we have some funds that are set aside to be able to continue to pay the utilities bills, pay the property taxes, and allow investors to kind of have peace of mind that you don't need to go and invest more money into that property. So when we have our kind of quarterly dividend review, we're basically looking at those two things. How much income did the property generate, and what can we spend out to investors? And what's the status of that cash reserves? Do we want to take some of that money that we've generated this quarter and save it in that rainy day fund? Or on the flip side, does our rainy day fund have a ton of cash in it that we're not going to need, and we should take some of the reserves out and actually pay that out to investors as well? So there's a lot of things that go into it. Cam, any other color to add on kind of dividend policy and operations there?
Yeah, no, I think you nailed it. And maybe we can correlate one of the other questions about as properties are held longer, why does it seem that their returns overall and perhaps their dividends as well seem higher? So Jeff answered part of the question in the chat saying, well, different vintage of properties purchased at different times with different basis, then property appreciation kicks in over the market, and that's some of the natural increase. The other has more to do with a stabilization period of operations as the property is getting ramped up. So I know the question was about going from 8 cents down to 7 cents, and Jake, I think, nailed the explanation regarding cash management. But I just want to maybe add some color with what a stabilization period is, why, you can see properties, change after a quarter or two for the positive or for, the worse. Generally, they're going to trend more towards the positive because in the beginning, there is a drain on the cash flow because the property is not occupied the day that we purchase it. We have to market it. We may spend 45 to 60 days with a vacant period, but meanwhile, insurance costs keep accruing, as do property taxes. So that cash reserve may be drained down initially a little. So when we're estimating our first dividend, it's kind of on an annualized basis, on a stabilized basis as well. So that dividend may come out at X, and then as the cash reserve drains down, though, because of operating in the initial period, that can cause fluctuations. So just wanted to bring up that, but generally it does have to do with income and then the cash reserve management.
Fantastic. Thank you both for walking through it. We'll keep cruising along here. The next one, we have one question related to the property updated valuation. There are two properties, the Hansel and the Redondo. Valuations are down 10% in Q2, yet both Zillow and Redfin show single-digit appreciation above the purchase prices. What are the reasons? Jake, you want to kick first?
Yeah, I can take it. So there's a lot of different things that go into those share prices. And the biggest component is going to be that valuation of the property. So for one thing, we look at Zillow and Redfin, but we also have a couple of other paid data sources that we look at that at times have different opinions on what the value of that property is. And then we have our team internally take a look at those valuations as well. Sometimes Zillow and Redfin can be a little optimistic on what those kind of property values may be. So we do have kind of a human eye that takes a peek just to make sure that there aren't any values that are too wild that kind of just flow through automatically. The other thing that is probably the larger component here is that remember that the value of the share is not just the value of the property, but also the value of all the other assets and liabilities that that LLC owns. So for example, Cam was just talking about the cash drain, where if it takes a while to rent a property out, we still have to pay out the expenses on that property. And that cash is a component of the share prices as well. So, if there were higher expenses on a property and we spent more than we thought because there was a couple $1,000s in repairs, that's now cash that the LLC no longer owns and decreases the value of what that share represents. Because that share in the property really represents a share of ownership in this LLC. And if that LLC no longer has that cash, then that kind of hampers the value. So there's a lot of things that go into it. Without diving more into those specific properties, that's all I've got, unless Cam happens to know what's going on with those off the top of his head. But largely it's that, either kind of differences in what the opinion of the property value is, or kind of the other assets and liabilities that that LLC owns that's affecting the price.
Yep. Yeah, definitely. And I'll also add that these two properties specifically, they have loans on them. So loans can magnify the impact of share prices because, let's say a property is worth $100,000, just as a hypothetical example. And let's say you have 50% leverage on there. So you're only putting up 50% of the equity. So it'd be a $50,000 loan and then $50,000 of investor cash. So any adjustments on the value of the property could be impacted positively or negatively, even more so because of that leverage, because the amount of equity that's outstanding that goes into the share price is smaller than the total amount of the purchase price of the property. So in the case of these two, Zillow is not the only data source. In fact, we don't use Zillow necessarily for the valuation of these properties. There's a combination of a couple other data service providers, and we look at multiple to triangulate it because any one particular data source may not be correct. And we've seen wild variations between all the reputable providers. So to the extent that we're hand reviewing these, the values may not match exactly with what Zillow or any one particular provider is saying. But on top of that, the leverage impact, of which both of these have 50% mortgages on them, is probably the biggest contributor to observing the delta of, say, 10% versus other properties that may oscillate in a single digit percentage up or down.
Fantastic. Awesome. Thank you both for walking through it. We'll cruise right along here, trying to get to chat as well. Steve, your question about the Sugar Creek, it's doing terrible. Can we talk about the 4% occupancy? Cameron, do you have details on the Sugar Creek in particular?
Yeah, definitely. This has been a challenging property, no doubt about that. And this is in Blue Ridge, Georgia. So it's a popular vacation rental market, probably a little bit too popular in the more recent years. Georgia has a lot of affordable properties. So to the extent that there has been an increase in supply, we've definitely noticed that. We ran some analytics on this when we were diagnosing the problems. And in the last 2 years, there's been a 400% increase in properties available that have 3 bedrooms, of which the Sugar Creek is a 3-bedroom property. So there is a couple of things going on. One, there is, hey, what's the property like to begin with? And for a long time, we didn't actually have any reservations. And we were trying to diagnose this with our manager. What we eventually came to find is that on the major online travel agencies, so VRBO, Airbnb, a listing that is saturated with competing inventory, so other 3-bedroom homes in that area, and also with little to no reviews as we were just starting out, that deprioritized the listing on the algorithm. So what did we do? We actually changed it to a 2-bedroom stay to try to compete in a different space to play the algorithm better, so it was more front and center. Because for a 2-bedroom place, a lot of times you're looking at condos, apartments, and smaller multifamily stays. But a 2-bedroom house that is more similar to a 3-bedroom experience, that gets highly prioritized. So actually the day that we did it, the first reservations started rolling in. So that was the lesson learned on really being sensitive to how Airbnb and VRBO prioritize your listing. So it's almost counterintuitive that we would decrease the bedroom count because, hey, why advertise less than what it is? Well, for those people looking for a 2-bedroom stay or a smaller stay, our home started looking pretty nice. And that's when the reservations started coming in. So it's still a work in process, but that was the main insight we learned from that and how we are seeking to rectify the issue.
Wonderful. Thank you so much for walking through it. We'll keep cruising along here. This one is from Matt. Q2 dividend payment on the Palm was only 0.8%, so 3.2% annual. Why so low with such a great occupancy rate?
Yeah, that is a really good question. So there's really 2 components to this. One has to do with occupancy and pricing strategy for a ramp up period, and the other has to do with income, right? Because income's got 2 components. It's got the revenue, of which you would expect 97% occupancy to be a really strong driver of, but then there's the expense side of things. So on this property in particular, our property manager, Roseas, they're very aligned with our strategy of reaching for high occupancy. So it's been priced to get a high number of stays and reviews early. Then incrementally, you build up your reputation and can alongside grow the average nightly stay rate. So that's a very intentional part of what we're doing here. So that played out nicely. The second part, which was more unexpected, is that, upon some of those initial guest stays, we found a significant amount of kind of infrastructure and utility work and HVAC work that needed to be done. So we're even kind of disputing with the inspector right now, trying to make a case for negligence on their inspection. So to the extent that we were unaware of these issues at the time that the build out was happening, we had to later spend the money to rectify that. So it came out of the expenses, and we actually had negative income for the period because of those expenses. So tying back to the cash reserve and kind of that discussion, we need to make sure that there's sufficient reserve. So the dividend did come down to be able to support just responsible management of that cash reserve. So that was the story on the Palm. That great occupancy, revenue rate is intentionally lower than we expect, but we'll ramp that up we've made the investments into the core infrastructure of the house. So the trajectory is looking good, but for Q2, that's kind of the juxtaposition between a really great occupied rate, but a slight lowering of the dividend to manage the cash reserve.
Fantastic. Awesome. All right. Another one in here from Matt. Are the 790K Q2 dividends based on true revenue generated? How much of that is return of investment capital? Jake, I will kick that to you.
Yeah, I think we're mixing up a couple different terms in this question. So the $790,000 of dividends is based on really the cash flow of the property. So not so much that kind of top level revenue, but after factoring all of those expenses, what is the kind of resulting cash that has come in and is still there after we've paid all the expenses? Really, like Cam was just talking about how the Palm was occupied, but may have had not as much revenue as it could have. That $790,000 in dividends is kind of based on that bottom line, how much is left. The second piece of this is on return of investment capital. This is based on that cash flow. So it's based on the revenue that comes in minus that expenses gives us our cash flow. When it comes down to return of investment capital, that tends to play in more with taxes. So what will happen is that at the end of the year, we'll basically tally up the financial statements and take a look at how much revenue and how many expenses there were. But then there's also the depreciation. So the depreciation tax benefit is an extra expense that you can basically count on the properties for the purposes of taxes, but it doesn't actually cost anything because you don't have to go pay a depreciation vendor anything for that property. So when it comes down to it from a tax point of view, next April, most likely there'll be a tax loss on a lot of the properties or just a small profit. And so on the tax statements, it will show up as a return of capital because any kind of dividends and distributions that are in excess of your profits are counted as return of capital. So from a kind of operational perspective, the dividends are all cash flow. From a tax perspective, there'll be return of capital for at least some portion of that dividend amount. But it'll depend on what the full picture of revenue, expenses, and depreciation are over the course of the year for us to really have those numbers dialed up when we do our dividends next January or our tax statements next January.
Fantastic. And Jake, just a quick clarification for Amit and Steve in the chat. They said for the 790K dividends, what percentage was from the reserves versus cash flow generated?
It's a great question. I don't have an answer off the top of my head, largely because it's a mixture of those two components. It's a mixture of the cash flow generated plus the kind of existing balance of that cash reserve. So some properties may have generated a ton of cash flow, but saved a bunch of it into the cash reserves and paid out a smaller or same dividend as last quarter. And other properties may have not generated as much cash, but had a ton sitting in their reserves. I don't have a great number off the top of my head, but that's a good thing that we'll take a look at for next quarter.
Fantastic. And just for you folks now, Christy, I have your question teed up in the chat. There's quite a few ahead of you, so don't worry. We will definitely get to it. The next one in here is from James. I know we chatted through this, but I want to be sure all the voices are heard. So I had 40 home properties and Q1 dividend was 1,051. During Q2, I added 6 vacation rentals. None have yet to pay, of course, but the dividend on the other 40 went down to 958. Curious why the drop of almost 9% quarter to quarter, considering all the properties are under long-term leases. Jake, I'll kick this one to you. I know we've walked through a few different scenarios, but wanted to make sure James' voice was heard.
Yeah, very, very similar to the story on all the other properties. The dividends tend to fluctuate, up and down a little bit quarter to quarter, depending on the property performance. Even those properties with a long-term lease, may have been that we had higher expenses this quarter, may have been that we were looking at them and decided we want to save a little bit of money into the cash reserves. We'll do a little bit of strategizing around, when are leases up? And if we have we know that a tenant's moving out next month, we'll keep a little bit of extra cash in those reserves so that we have money for that kind of vacancy period. So, all in, that is a pretty normal fluctuation from about $1,000 in dividends to 958, especially with those long-term rentals where it's going to end up being pretty consistent in their payout amounts. Kind of that little tick up and tick down seems to be pretty normal. I wouldn't expect to see something like $1,000 in dividends received and then like $200 the next quarter with those long-term rentals because they're on those long-term leases. But kind of a small fluctuation like that looks to be kind of within the normal operating bounds of how we manage the performance of the properties.
Fantastic. Awesome. Thank you so much for walking through it, Jake. I'm going to cruise right back over to our questions that we have. This one is from Mirza. Do your management fees go up if assets are appreciated? Jake, I'll kick that to you.
So they actually don't. The management fee is listed on each property's page, and it's set up as a percentage of the purchase price for those long-term rentals. So for those long-term rentals, it's going to be consistent throughout the entire life of the investment, regardless of the property performance. The vacation rentals do have a variable fee, but it's variable based on the revenue generated, not on the underlying value. So with those vacation rentals, we have a kind of assets under management fee that's tied to how much rent we're able to generate. So if we're able to get a higher revenue for the stays, the vacation rentals, then we can pay out higher dividends to investors, and Arrive is able to earn more for our kind of work in actively managing those properties. But that fee is based on the revenue generated. It's not just based on the estimated appreciation of the properties.
Wonderful. Thanks for walking through it, Jake. There is another one in here from Raphael. Strong correlation between months owned and dividend rate. Why is that?
Dual answer. I'm gonna have Cam chime in on this too. For one thing, properties that have been owned for longer have had a longer time to season in. So we had an opportunity to kind of see what that real performance is. We try to be conservative in those initial dividend rates that we pay out. And then as we start operating, we start to recognize and see, okay, here's the actual amount of expenses we're going to have each month and each quarter and each year on this particular property. The other component that plays in there is the increasing of the rent. So especially with those long-term rentals, we kind of have a fixed amount of revenue per month, for the first 24 months. And after that, as leases start to turn over, that gives us an opportunity to increase the rent and hopefully be able to increase the rent faster than inflation is causing the expenses to rise, because that allows us to have more cash flow, which we can then distribute to investors. And the other component of that is, purely a kind of apples and oranges problem. Some of those charts aren't perfect at isolating the kind of why things are the way they are, largely because, a year or two ago, we were buying properties with loans. So some of those properties have mortgages that are at 4%. Others of those have no mortgages, and others have mortgages at 6%. So it's not perfectly apples to apples. We're also mixing in different markets, and our mix of markets now is a little bit different than our mix of markets was, 2 years ago. So there's a lot of different kind of confounding variables on there. I wouldn't want people to draw the conclusion that, the longer you own, therefore the dividend goes up. It certainly is in there and plays a role, but it's also, there's a lot of different things going on in some of those charts.
Yeah, nothing to add on. You killed it, Jake.
Yeah, that was great, Jake. I know there's a few questions from Yulia, and I believe one other person regarding squatters. So Cameron, maybe we walk through how we handle squatters or evictions as a whole, and then we'll get into the two particular properties. I believe there was mention of the Lithonia, and then the other one was the Bell, and how we communicate with folks.
Yep. Yeah, absolutely. So squatting is definitely a challenge. And maybe even before we get into some more details about those two specific properties, we go over the difference between a squatter and somebody requiring to be going through the eviction process. So squatting occurs when there is somebody who occupies the house that is not entitled to, neither through a valid lease nor maybe through any lease instrument. So house squatters typically get into the house are two variations. The first one is more of a malicious squatter. So it's somebody who purposely takes out the key, maybe changes the locks, goes into the property, and then just stays there as if it's their own. You can imagine any sort of illicit criminal activities going on, or just malintention there. The other one is I don't want to say a more benign case, but it's where, say, a property goes on to Craigslist, that scammer recreates a listing, gets access to the key, and then attempts to advertise in a ridiculously low rate, of which people kind of, if they're on hard times, they're like, ooh, that's something I can afford. I really want that property. And they'll sign what they think is a lease with the owner for somebody who's purporting to be, and then that person ends up as the squatter. That's always a challenging case because they're not in there maliciously, or they're there because they thought they signed a lease, and then they get kind of blindsided saying, hey, you signed a lease with somebody who's not actually the owner. So that's a real challenge, and which sometimes we do have to go through the eviction process to get them out, because they really believe with the best intent that they're entitled to be there. And not every property that has a squatter has to go through the eviction process. Some people do understand what happened and they'll voluntarily move out, but many times we do have to go through the eviction process if they're not willing to cooperate or believe the circumstances. So with the Bell, these processes can move a little bit slowly. So there's definitely some updates on the site indicating whether there has been progress made. I am happy to announce that for that property in particular, we got the squatter out, we relisted it, and we actually already have an approved applicant on that. So if you were to check out 1205 Ithaca Drive in McDonough, Georgia, you'll see the progression of when we listed it. So on July 5th, we were anticipating that the property was going to be vacated. We performed the necessary renovations, and we actually leased it out for I want to say that we have an approved applicant with a preliminary signed lease for $150 more than the original rate of $24.95, which was achieved in August of 2022. So it was a great success story on this one in particular, as going through an eviction can really be a difficult process that takes longer than a couple months. Fortunately, in this case, we filed the eviction in mid-May, and we had gotten the squatter out by the end of June and leased it within a week. So overall, that was a great success story. One we wouldn't necessarily expect to replicate every single time, but we do work closely with our property managers to make sure that they are pushing as hard as they can to clear out the squatter. And then the other property, the Lithonia, we're still working on that squatter, but on that particular property, Arrived is covering the rent on that one, just to make the investor whole on that particular property. So hopefully we'll see some movement on that. But in the meantime, we understand the frustration with it, and we're helping out as much as we can on the Arrived side.
Definitely. Yeah, we understand, obviously, in real estate that rough situations can still occur. We're doing everything that on our side to operationalize and move forward as quick as possible. Also, I do want to say, in terms of communication, we heard our investors loud and clear on having updates. So to date, we do showcase monthly updates, typically on the 5th of each month, where you'll be able to see that on each and every property page in there. So take a look there. Let me know if there's any questions that you might have. We found this is the most effective way to communicate effectively, but we would love to hear any feedback that you have along the way. Christy said, thank you for the update. Great questions, Christy. We're thrilled to have you here today, and grateful to have you on board. All right, let's keep cruising along here. This one is from David. There are numerous reports that Airbnb rental income has been decreasing this year. We've seen that. What is Arrived's plan to avoid this? Cameron, I will kick this to you.
Yeah, definitely. I think that there's been a lot of sensational headlines around the vacation rental markets that, kind of proclaim that the sky is falling in the vacation rental market. We personally haven't seen this. Now, with that said, the question is, what's Arrived's plan to avoid this? So maybe I can just generally go about our vacation rental strategy and our buying strategy. So we are what we call horizontally integrated as opposed to vertically integrated. Vertical integration means that you would have full-time employees servicing the process from top to bottom. Usually what that requires is density in a market. So you may be buying a lot of properties in any one particular market because you have to get enough volume to justify the cost of hiring a full-time employee team to service the asset and operate it. So horizontal scaling is the opposite. So we leverage a partner network and we do the asset management on every single property. It's more like we're just choosing the vendors and really closely watching the operators. But what it allows us to do is have the freedom and flexibility to selectively choose assets all across different markets. So you'll see our spread in that the 37 vacation rentals that we've IPO'd to date, they're spread out over nearly 15 markets. So to the extent that we're reducing the systemic risk of any one particular market, that is a very intentional part of our strategy to be able to participate in homes, only the ones that we really, really want, that are that we think are going to be top performers, as well as hedging out the risk of over concentration in any one market that may see those particular declines. So I think that we saw some headlines regarding the Phoenix market and Scottsdale in particular, because the state of Arizona has very, very favorable regulations with regards to short-term rentals and vacation rentals in general, which is almost no regulation. So you can see how it might be easier to add supply there. But Phoenix is the 8th largest MSA in the country. So there's still a lot of people visiting. It's one of the top golf destinations in the country. So we haven't noticed that with our vacation rentals, even that they've been suffering in the areas where there's proclamations that there are decreases in revenue. Certainly you can probably imagine that some of the vacation rental demand that we saw in 2022, I think they called it revenge vacationing, in the sense that people were cooped up in their homes for a long time because of COVID, and then there was an explosion of travel. I think that that's fair to say that going forward, there may not be that intense of a spike in vacation rental reservations like we saw in 2021 and 2022. But with that said, a lot of the headlines, sometimes you have to look at what are they measuring against. So if they're saying the basis is that crazy year of explosive growth, then you can imagine that the ongoing operations and vacation rental markets, they may not perform to that degree, but they're still healthy. And that's what we're observing, in that in a lot of different markets, our vacation rentals are performing quite well with high occupancy, with good rental rates. I would say that there's a couple exceptions that we talked through. So Blue Ridge, there was a challenge with supply, and we're working to address that. But from our perspective, both the purchasing markets and the vacation rental consumption markets seem to be pretty healthy. So we're closely monitoring it, but I think that the first answer to the question about how we horizontally scale and therefore can be very selective about the assets is the overall strategy with Arrived, whether it be single family residential or vacation rentals. We like to hedge our exposure and not get over concentration in any one particular market. And of course, we recommend that our investors diversify across all of our assets to reap the benefits of that intentional play to spread ourselves across markets.
Fantastic. Thank you so much, Cameron. I saw a quick question in here. Do we list our vacation rentals on booking.com or only on Vrbo and Airbnb? We're on Airbnb, Vrbo, Marriott Bonvoy, booking.com, Expedia. They're also, like Jules just mentioned, who's part of our vacation rental team, they're listed on their sites as well. So it's another great resource. And then Brett, our head of content, also linked a wish list for Airbnb in particular. We also showcase them on each and every property page. I know there was great feedback in here from Leon about having this even more explicit in our marketing materials to increase occupancy. So we hear you loud and clear. I know there was more feedback too in here from Matt about getting monthly updates, newsletter format for all the properties that you own. So fantastic feedback. Love the idea. I know that's something we want to have in the future. So hear you loud and clear and appreciate all the feedback coming in. We're building for and by each and every learning or existing investor in Arrive. So please keep the feedback coming, whether it's a product, a different product type, asset class, changes within the platform, a market that you want to see. This is the best place, as well as our email, support@arrive.com, social, Reddit. I know there was a person in here that mentioned our Reddit. We'd love to hear it. So keep it coming our way. All right, let's get back to these questions. A quick one from Bill that I always love to filter in here. I've currently been investing in Fundrise for the last few years. Is Arrive very similar to Fundrise? So Jake, can you quickly touch on this before we go back to our theme of Q2?
Yeah, I'm going to hit it quickly from a structural perspective, and then I'm going to throw it to Cam from a property perspective. With structure, Fundrise can be a great option. Structurally, they're just built a little bit different, where you invest in kind of a general fund, and that fund owns a ton of properties. And that can work out well because you're instantly diversified from your kind of first dollar that goes into that fund. But there's two big drawbacks that we tend to see from folks. The first is that it's really difficult to understand what you actually own. And that fund owns hundreds or thousands of different properties, and it's difficult to do any kind of research or due diligence into the quality of what real estate you actually own. Versus with Arrive, you're obviously making an investment into a single individual property. So you can go look up the address, check it out on Google Maps, and do a little bit of research and digging before you kind of commit your dollars to something. And the other component there is the customizability. The Fundrise and all of the other kind of public REITs and general funds for investing in real estate don't really have any way for you to customize what you own. It's either buy into the fund or don't buy into the fund. It's very black and white. But with Arrive, you kind of have the ability to build yourself your own custom real estate portfolio. We've had folks say, I want to invest across the US, but I don't want Florida because I'm worried about hurricanes. Or I'm going to dig in and find all the homes in the best school districts and only invest in those properties. So there's the ability for you to kind of match what real estate you own to what you're looking for as an investor to kind of build that custom real estate portfolio.
Awesome.
Yeah, and Fundrise is they're a great company. So I have nothing but great things to say about them. I think another difference though is Fundrise didn't have its roots in residential real estate. They started a little bit more in the commercial and like non-residential space. So to the extent that our company has really focused on single family homes and single family residential as the core asset class for generating wealth. And there's a lot of reasons why we believe that, but our DNA is in single family residential. So all of the plays that we're looking at is very nuanced and specialized within residential. So I would say that, for now, that's our identity. That's what we're really focused on. And all the great points that Jake mentioned and being able to customize your portfolio, you can pick from all those great residential assets that we're finding across the country to build your own. So that's just a little small addition to kind of what is a fundamental difference. Well, it's kind of our approach to the value of real estate. And we place a lot more emphasis into single family residential.
Absolutely. I think too, obviously, Jake and Cameron, and for everybody on the line, there's a whole host of different ways to invest: CDs, traditional REITs, stocks, other great companies that are similar to Arrive. We always recommend taking a look at the offering circulars, not only ours, but any that you're looking at in the future, just so you know, and ask all the questions that you have. So keep it coming our way. Thank you, Jake and Cameron, for the insight. Let's keep cruising along here. The next one we have is from Serge. Jake, I'm going to kick this one to you. What was the reasoning behind extending vacation rental properties evaluation date to a year? Isn't this a simple data feed directly from a third party like Airbnb or the like? Another word, I am not sure. We have to wait a year to update the property evaluation on the account. Can you elaborate this? Absolutely fantastic. Jake, I'll kick it to you.
Yeah, great question. For one thing, we're definitely trying to accelerate it sooner than 12 months. We're working on some things this quarter to really narrow down the data and make sure that we're comfortable with the overall methodology before we start to roll it out. I think ideally we'd like to do it at that 6-month mark, the same as the single family residentials, but there's still a couple of things that we're figuring out. And really the issue is the difference in the way these properties are operated. So with the long-term rentals, we buy the property and there isn't really a ton of improvements that we do. We do a couple $1,000s worth of work where maybe we add a fence, touch up the paint and whatever else. But for the most part, tenants then move in and they're moving into an empty building. There's no furniture already there. They have to kind of bring all of their own stuff with them. And so that makes it easy to reevaluate the value of the properties because we just need to value what is the value of this actual structure. And we can do that by looking at comparable properties in the area and then doing that process of combining all of the other assets and liabilities that LLC owns. And that really makes a ton of sense because when we go to sell those long-term rental properties, most likely we're going to sell it to someone who's looking to move into it as a home. And someone like that is going to say, hey, the property across the street is worth $350,000. This home is slightly larger, so I'm willing to pay up to $360,000 for this property. But the vacation rentals are a little bit different because of how they're operated. The vacation rentals, we put a ton of money into the property improvements. We're buying all of the furniture. We may be building out a pool, adding a hot tub, all of these other components that add to the experience and make that property usable as a vacation rental where, someone arrives and they expect that there is a bed and sheets and towels for them to be able to use. And the difference with these two operational strategies is that when we go to sell the vacation rentals, it's a lot more likely that we're going to sell it to somebody who is a real estate investor. We're already going to have all of the kind of components in there for it to be operated as a short-term rental. And so the most likely, exit play for those properties is to sell to someone who wants to buy it and then operate it themselves as a vacation rental. And so that's really where the difference is that when we look at, well, how does an investor value a property? They may look at comparable properties in the area, but those comparable properties don't also have the value of all of this kind of furniture and improvements that we've done on the inside of the property. And an investor is much more likely to take a look at the actual cash flow that the property generates and try to figure out what that kind of potential stream of income looks like. So because of that slight difference in, how we might sell the property and how a buyer might look at what the value is, we're trying to make sure that we are sharp on the way in which we value the vacation rentals, because that process is a little bit more different. And we may be able to get some data from, AirDNA or someone else on some information, but the vacation rental space in general is so new and so young that there isn't a ton of kind of institutionalized resources on saying, hey, based on the revenue and the expenses at this particular property, here is about what we think it's worth. So because we're going through this process of kind of figuring and building out the foundation of how do we do these valuations for the vacation rentals, we decided to, kick it out a little bit longer so that we could really be comfortable in the methodology and, feel like we are putting forward a fair price for what those shares are worth to investors. That's largely what we're working on now. I certainly hope that we're able to have that process finalized before the 12-month mark and, ultimately be able to revalue those properties sooner. But in the interim, we wanted to, make sure that we really felt comfortable and had all of the I's dotted and T's crossed before we started to roll out information about the kind of estimated appreciation to investors.
Awesome. Thanks for walking through it, Jake. Serge, great question. Like I said, as always, awesome explanations, and they completely understand. So appreciate walking through it. Jake and Serge, thank you for bringing it to the table. I saw a question in here about the Android app from Emmanuel. We're working on that in the next year or so. So we will be sure to share more details. If you would like to join the beta when that takes place, feel free to send a note to support@arrive.com. We'll get you added to that list. And we know this is of importance as we have iOS live now. All right, let's go ahead and hop back to the questions that we have here. This next one is from Steve. I noticed that the Blue Ridge vacation rentals have low occupancy in general. If a performance doesn't improve, what does Arrive have in mind? Cameron, I will kick that to you.
Yeah, definitely great question. And I think it depends on the magnitude of what we're saying underperformance is, right? So if we're losing cash, certainly that would not be ideal, right? We would probably explore everything we can with a vacation rental first in terms of pricing. Our assets are generally newer, rehabbed well, and I would say on a little bit on the more premium side of the vacation rental market. Now, with that said, if we're talking about worst case scenarios, what are our options? Well, there's always the option of selling, right? And that may not be ideal, but it is possible that that market may not reward vacation rentals as much as, say, the residential market. So it's conceivable that we could sell it still for a potential profit, and that might be an exit. The other alternative could be, well, does this work as a furnished long-term rental? So to the extent that it's still a single family residence, you could operate it under both models. And if we're finding that the income generation from that is superior, that is an option. Other options include changing management. So we do utilize a third-party manager, and they've been working very closely with us hand in hand in trying to diagnose the problems, identify what the solutions may be, such as talking about moving from a 3-bedroom to a 2-bedroom listing. Again, that seems like initially that seems pretty extreme to me. I was even a little bit against that, but we said, well, let's try it because some percent is better than 0%. We tried it and it seemed to work. So I think there's a lot of solutions still that we can attempt. I think there's also a lot of marketing things we might be able to do. So we're primarily using the online travel agencies as that method to put the properties in front of people, but there also is direct marketing. So sometimes smaller markets have little nuances about them where different marketing strategies may work. Maybe there's flyers that we may, send to people in the neighboring towns, or pay for search, SEO type advertising in more local places. So I don't think we've explored all the options yet, but changing management, changing tactics in terms of how we market and putting more dollars towards marketing directly, that could be an option, or more drastically sell the property or operate it as a long-term rental.
Wonderful. Thanks so much for walking through it. Really quick question in here from why do shares of properties that are currently not for sale ever come onto the market? Or if we miss the first time, did we miss it forever? Good question. So we have properties that are in coming soon. You can choose to be notified via text or email. You'll be able to see that funding, whether it's 10%, 50%. Once it's 100%, it's no longer available to invest in. Oftentimes for properties, you'll see them move in and out of being fully funded within the first couple of weeks. It can happen because of bank errors or cancellations, but essentially once those are fully funded, they're no longer able to invest in. We have quite a few on the platform now, and why we typically release new properties every 1 to 2 weeks. For this summer, it's every Tuesday at 11 a.m. PT, typically around 2 to 3 properties at a time. And we actually have Cameron Wu, who you see today, and Jeff Talbert, who we have in the chat, who's answering a myriad of questions, walk through all the properties and all the details. But let me know if you need any color on that, and we'll keep cruising along here. I saw Steve said thank you, so wonderful walking through that, Cameron. Quick one, I'm going to kick over to you, Jake. Why doesn't your company tokenize these properties?
I'm going to throw it to Cam. Cam's more of our resident crypto
right.
guy.
Perfect.
Yeah, so I'm a crypto person myself, right? So I own crypto. I'm supportive. I love the idea of a blockchain and decentralization. So when we're talking, just to get everybody up to speed, when we're talking about tokenization, we're typically talking about the blockchain space, right? So maybe a digital representation of the asset. So let me try to take 2 angles to this. One, I think that there's the angle of would we use crypto to transact value, right? So could you, instead of using cash, could you use crypto to purchase investments? So that's one complexity that we've tried to avoid, just because there's so many uncertainties regarding crypto, as well as its usage and its viability as a transacting currency within the US. So we're squarely within the rails of the US dollar system and the financial guardrails and infrastructure that this country has in place. And so we have no plans currently to deviate from that. But maybe on another part about a mechanism for, representation of what that value is once the US dollars have already transacted. So I think that crypto is a great mechanism to, say, divide something up and have digital representation of it. Now we have shares, so we do have digital representation, and we could develop a secondary market, which is, say, like Robinhood, where buyers and sellers can trade shares of Apple. So all of those features do exist. But I think that the crypto space offers benefits beyond that, such as conferring rights to whoever may hold it, right? So just by virtue of holding the token, we may be able to ascribe economic rights to that. So I leave the future open as saying crypto could be a adequate, or a superior mechanism to actually exchange value, maybe once it's already in existence. But when it comes to securities, there's a lot of challenges in trying to mix securities with crypto. So on the security side of things, we very much stay within the prescription of the SEC and the US dollar system. But as a feature of how we may be able to represent things, and once it, as a product, I think crypto does have some nice use cases there.
Absolutely. I should have known that. JW just tapped into your love language a bit there, Cameron, and appreciate you putting on your professor hat. Great question. We'll move on to the next one here from Amit. Cameron, what are you seeing as overall effect on home prices falling in risks with rent also falling? What markets are hit most so far, and which markets are resilient? Great questions.
Yeah, awesome question. There's a lot loaded in here. So let's first talk about home price values. And what are they doing today? So it's, I would first start off saying real estate is not homogenous. So we really participate in 2 distinct parts of the market. First, I would say that it's more entry level, new core housing that we participate in. So sub $300,000, very recent builds or even new builds. And that market has been extremely resilient. And in fact, I haven't seen any decline in that market. So I would say that There are some geographies that have been hit harder than others, like in our own backyard, Seattle. Seattle's home prices have gone down like that, and that's just a fact. It kind of makes sense why. There was a big tech layoff round, within the last year. A lot of tech jobs here, a lot of expensive real estate. So as interest rates go up, when applied to when those rates hit expensive homes, the ability to cover that mortgage really declines. So Seattle in particular was hit. But more commonly, I see the divide between price points as opposed to geographies. So the other market that we participate in, vacation rentals, there's less buyers in there. So not as many people can afford $1 million home. So when we come in, we lowball pretty hard on those. And I'm talking like offensively low sometimes. I remember in particular, there was a property that was listed for $1.4 million and we offered them $875,000. So they weren't very amenable to that. Nonetheless, they didn't, just slam the door in our face. We kept going back and forth and they landed at a price that we didn't want it for. But nonetheless, we do have, kind of the ability and the gall to go in and lowball on those prices. So I would say that the very high end of the market, there is some weakness there because interest rates will disproportionately affect high price points. But we're capitalizing on that situation by having those really low ball offers. So when we do lock it in, we feel good about the basis that, that segment is weaker today, but we just got a 6-figure discount and we feel good about that. So that's my general commentary on home price appreciation. And just to give a little bit more anecdotal evidence of why do I feel like this? On our new on our single family residential properties, a lot of those new home builds and resale inventory, if you're not winning the bid within 3 to 5 days, you're not going to get it. Those properties sell and get under contract in less than a week. So the market is still capable of bearing lower prices, and there's still a huge amount of demand for those more accessible price points. So we have to be extremely competitive there. So I say that the markets are healthy there. The markets are less healthy at the higher price points, and we're capitalizing on that. And now let's talk about rents. So I would say that the biggest risk with the rental markets is potential future evictions. So I say that because with rental rates, if purchasing becomes more expensive, people still have to live somewhere. So they substitute into rentals. So generally we're seeing the demand for rentals go up. And with that, it'll at least maintain, if not increase the rent levels. So rents are, even in this environment, are still going up 4 to 5% on an annual basis, while home prices, and of course it depends which segment you're talking about. Let's just agree that they're more or less flat right now. If you were to just take everything overall, there's flat with some slight variations up and down. Rental prices, I don't think is as objectionable. I think that there's a clear appreciation component on the rents. But on the eviction side of things, what we've seen is with the ending of the moratorium, just kind of a backlog of housing issues to solve, the court systems are getting overloaded. So there's naturally going to be about a 8 to 10% rate of eviction. So if you had 100 homes on an annual basis, you would expect about 8 to 10% at any given time to be in evictions. That's based on my experience at American Homes for Rent, where we had over 50,000 rentals across 40 markets. So it's a pretty good sample size that we saw over the years, and that stayed pretty consistent. You would also expect that for the early termination rate, which means people who break their leases early, they're both in that kind of high single-digit percentage. But the risk is that with the court system, they're not going to be able to process them quickly, and there's not much you can do about that, right? You can only force the judicial system so far. And if somebody has kind of you captive in that eviction scenario, that to me is the biggest risk, because you're losing out on the rents, not to mention the potential destruction. One side note, since I mentioned that that's the biggest risk from my point of view, one of the things that we do to alleviate that is offer a program called Cash for Keys whenever we can. So Cash for Keys is making a payment to the resident who's fallen on hard times and isn't able to pay, the option to take a lump sum to break up amicably. So leave the property in a good condition. We're not going to file an eviction against your record, and that follows you for 5 to 7 years, by the way. So we're not in the business of compounding people's problems. We're in the business of trying to provide great housing and have good results for investors. So offering that eviction tenant a lump sum to break up cleanly is, from our experience, the best solution possible. Lost rents cost a lot. Potential damage costs a lot. Imagine that they are vengeful and want to strip the copper. So it's never in our best interest to be adversarial with the tenants. It's always in our best interest to give them an out that economically both parties will benefit from. Plus, it's just good karma as well to not compound people's problems. So hopefully that addressed your question, but it was a great one.
Yeah, great questions. Appreciate you walking through all the details, Cameron. I know we're 12 minutes over. How y'all doing on time? We have about 4 more in the queue.
Let's go.
All right. Let's keep cruising. This one is from Ronnie. This quarter, my portfolio shows the Jill depreciates 1.9% and the Hansel depreciates 10.6%. These properties are located in Tennessee, built at the same time, located at the same road, the same model, and the same square footage, but depreciating at a very large gap. Cameron, can you walk through why this might be?
Yeah, so it is a good call, and they are properties in the same neighborhood. They were purchased at different times, which can impact, say, the leverage amount, as well as what we may have purchased the property for. Now, we issued over 200 dividends in our most recent batch, so I don't know the exact details. So let's table this one on the exact details. We'll hook up with our asset management team and look into these 2 properties specifically. But we'll definitely get back to you, Ronnie, on kind of the disparity between the 2 results.
Absolutely. And Ronnie, if you're still here and listening, I did see you wrote in. So we'll definitely follow up via chat and email with you after, like Cameron mentioned, connecting with our AM team. Moving right along here, there was another question from Rick in chat. Always wondering, perhaps you can't say, but can you offer approximately how much average or mean share price is purchased per property? Just curious. And I'm sure there are several styles. I, for one, invest in several properties at a smaller amount. Others perhaps invest in greater amounts on fewer properties. Can you discuss ballpark averages?
Yeah, no, certainly. I think that from the last I looked, on a per property investment basis, it's around $600 that the average investment amount is for per property. So if you were to say invest in the round of the 3 most recent drops, it'd be 600, 600, 600. On a slightly different angle, what is the average amount per investor across all properties? Last I checked, it had been tracking around $3,500. So as they build their portfolios, they might have $500 to $600 average investment with 5 to 6 properties. And of course that, we're still very early in the game, so we don't know the full, what it fully looks like going forward. But to date, that's about what we've seen.
Fantastic. Awesome. Great question, Rick. Let's move back to questions over here. There was one in here from Crystal. Do you ever buy from wholesalers instead of retail?
Yeah, definitely. Good question, Crystal. So our buying channels definitely include wholesalers. And just so everybody's up to date on what a wholesaler is a wholesaler is a market maker, a liquidity provider within residential real estate. So think about the company, say Open Door or Zillow Offers, which is now defunct, but at the time, they had a wholesaler operation. What they'll do is buy off-market properties. So maybe you all have gotten calls saying like, hey, I see that you own this property, my company is buying. And that is essentially what the wholesaler model is that they'll straight up buy cash in an easy transaction, but at a pretty good market discount. And from there, they'll find another buyer who is wanting that property. So we've purchased properties from Open Door, although they have typically been publicly listed on the MLS. So we're not necessarily buying in a wholesaler capacity where everything is off market, but we have bought from Open Door in a who is a wholesaler in the real estate markets. And we've done a couple off-market transactions with larger partners who they have a portfolio of properties and they're looking to diversify out of some of them, and we would purchase those at discounts to market and then offer them on the platform. It's not a huge part of our business though, because quite frankly, you don't find quite as many of the properties that we want to buy from wholesalers. The properties that we're typically buying are very recent builds. And I would say that over a third of our single family residential purchases are actually new builds, like from the builder. So those are, would not be considered wholesale transactions, but that's been the opportunity that we've identified, is buying from the builders has been the best source of acquiring the properties that we want.
Wonderful. Yeah, great question, Crystal. We have one more from Ahmed that we'll close out on today. What are the pros and cons for investors investing in Arrive versus AMH or INVH stock at discounted prices? Ooh, Cameron, I know you probably love this one.
Yeah, definitely. So this is my former life, my old world, public REITs here. So AMH, they are American Homes Rent. They've rebranded to AMH, but most people will know them as American Homes Rent. And INVH is Invitation Homes. So these are the two largest public single family residential landlords in the country, and they are public. And I would say that is probably one of the biggest differences between purchasing properties on Arrived versus investing in the stock, is that when you buy public stocks, you get a lot more than just the underlying fundamentals of the company. You get the operating company plus the real estate that they buy, plus everything that comes along with being sloshed around with the trillions of dollars of other public market securities. So there was a stat we looked into. So from 2020 to 2022, the average performance of REITs were down, I think, a double-digit percentage. I don't want to throw out a false number, but it was in the magnitude of negative double-digit percent return. Call it negative 15% return on the stock price itself. Meanwhile, if you look at the Arrived index of all the properties that we have been purchasing since 2020, we were up a similar double-digit percentage. So we were on the opposite end of the spectrum. And why is that? Well, it's no surprise that real estate went on a really great tear on and was appreciating quickly during that pandemic period. So how is it that the real estate stocks were going down when they're participating in the same business model and participating in the same asset class? And the difference really comes down to public market exposure. So portfolio managers who are managing billions and tens of billions of dollars collectively, they're making decisions on how real estate is a certain part of the segment. But if they want to be out of the markets, they're selling, right? So if they sense that risk, it almost doesn't matter what kind of companies you're at. You have that public market risk, which is very tied to just institutional capital and interest rates, just very large macro stuff. Whereas Arrived, it's all about the fundamental real estate, the operating plan, and the cash flow. Like that's what drives our dividends. And then the resale market is what drives the home values. So it is very much closer to a direct real estate investment compared to a fund that has a lot of public market exposure embedded into its price of those shares. That plus some of the answer of what Jake had explained earlier about the difference between Arrived and, say, Fundrise, is that AMH and Invitation Homes, those are very large portfolios where when you buy one share, you just bought 50,000 properties. Whereas in Arrived, you're crafting that portfolio to your liking. So those are the two major differences between us and the public REITs, REITs, real estate investment trust, but single family landlord operators. I wouldn't say one is better than the other. That's probably not the right word to use, but just understanding the difference between what you're actually getting when you purchase those securities is the point that I'm trying to articulate.
Absolutely. Yeah, Cameron, thank you for the in-depth response. Amit, great question. Fun fact, too, we also had Fred Tomey, the former CEO of Invitation Homes, not too long ago do a fireside chat with us. He's also one of many who have backed Arrived as a whole, which is fantastic. We've also had Spencer Raskoff, and also just yesterday we had John Burns on with Ryan as well. So we'll be sure to update the webinar landing page, so you'll have access to that. One last question in here. Will you all be doing a roadshow in the future? Great question. We have hosted a few investor happy hours. We tend to pair those with our offsites that we typically do on a quarterly basis. So definitely great feedback. We'll be sure to share more as we continue to do those. We absolutely love meeting in real life. There's something to be said for that. One last question in here from Mike, because I did see a few folks working on or asking about liquidity, and I want to be open and transparent about where we are today. Jake, do you want to give a quick overview before we shut our virtual doors?
Yeah, we're working on developing the right liquidity options for investors. I don't have a timeline right now on when that would be released, but we're exploring a couple of different paths. The one I think that's the most exciting is the idea of a secondary market where buyers and sellers can come together and basically let the market discover, what the price is for those shares, where, we would have our kind of published share prices for informational purposes, but really the value would come down to, what is someone willing to sell your shares for, and what is someone willing to buy those shares for? Don't have a timeline for something like that. There's a lot of really fun SEC and IRS rules to play around with, and then kind of figuring out from a kind of tech and product perspective, how do we make that, the right investor experience for someone who is looking to sell their shares before we hit that kind of point where we decide to sell the property and wind down the investment entirely. So definitely some things in the works, hoping to have more updates in the coming months, but no timelines yet on any kind of a release. So what I generally tell folks in kind of our intro to arrived calls is, treat it like an illiquid investment, where you invest, you have to leave that money invested until we actually go to sell that property. Odds are we'll have a secondary market or liquidity options developed in the coming years, but it's smarter just to, be conservative in how much you invest, knowing that it's kind of locked up. Really a lot like a retirement account. You invest in your 401k and you kind of know off the bat that these are dollars that I'm not going to be able to access in 6 months or a year or 2 years. It's kind of that long-term investment that's waiting for that long-term growth, and then I'll be able to access kind of later in the future.
Awesome. Jake, thank you so much for walking through it. We are built on accessibility and understand that this is important to folks, but to date, we do not have any options to liquidate your portfolio or transfer or gift. Mike, great idea on the transfer or gift. We've had a ton of feedback around that, even for folks that are graduating high school and then, once they turn 18, that they'd be able to be gifted Arrive shares. So something we're definitely considering in the future. But Cameron, Jake, any closing remarks before we shut our virtual doors for the day?
This was an awesome set of questions. It's always fun to do the Q2 or the financial performance webinars, because we have the investors who've seen the evolution of everything that we're doing. So we get really good questions, technical questions, specific questions. So y'all really know your stuff. So it was a great session. Enjoyed answering all the questions, and hopefully we did a sufficient job of informing y'all of any things that you may be wondering.
Yeah, I echo all of Cam's sentiment. Great crowd. A lot of fun chatting with you. These are always one of the highlights of my quarters. So thanks for investing with Arrived and joining us today.
Awesome. Well, Cameron and Jake, thank you so much for your time as always, and all the effort going into creating this for folks on the line. And to everybody in chat, thank you so much for the engaged audience. An hour 24 of absolutely fantastic questions and engagement. 56% of you are new to this type of webinar, which is absolutely phenomenal. Lots of great feedback in the chat. Hamant in particular would love to hear your ideas for what you would like in that roadshow. We'll be sure to share that with our team after. It sounds very fun to us. I'm seeing lots of great feedback in chat. We so appreciate you all. If you have any questions, feel free to ping support@arrive.com or use our chat function in the bottom right-hand corner of our platform. As mentioned, we also have Reddit, Twitter, Instagram, Facebook, carrier pigeons out and about all the time. And then also thank you to our Arrive team in chat. I know Jeff was in there, Brett, Victoria, Jules. If I'm missing anybody, we appreciate you for being here and helping our investors. So hope you all have a great rest of your day, and we will catch you all later.
Thanks, folks.
Bye, everybody.
Thanks, everyone. Take care.